this is not exactly convincing in direction. Neither is this. So where do I want to be? I want to be looking at something that I can at least be confident in what direction it's going to go and that it's going to sustain direction. So from a story that seemed to have zero traction at the beginning of the year, this has been the biggest day of the year and all on really 1 5-minute window. And this is where the biggest performances come from. You've got a market that's highly sensitive, highly volatile, put it in very big ranges, and then this constant input of new information relating to tariffs. That's where the big opportunities really lie. What I wanted to do today was just give a little bit of a sense of, well, what should we be looking at for this year? Also a little sense of expectation as well. One of the really important things, particularly on the back of what was, I think, not short of a spectacular year last year, is recognizing the impact that that can have on your future performance. There's a number of themes that have already started to pop up. You've got the Iran uprising. I talked this through with a fair few of the guys who are on our blueprint training yesterday. And we looked at some of these and how these things could break up. I'll come on to then the subpoena of Powell and the new Fed chair, which essentially is the same thing. The impact on markets is very similar in terms of the two, because ultimately, if there is a criminal charge brought against Powell, that leads to a new Fed chair, perhaps marginally sooner than we're going to get a new Fed chair, or at least know who the new Fed chair is anyway. For context, Powell will be the Fed chair for the next 3 meetings, so the January, March and April meeting. So unless anything goes particularly fast in this court hearing, well, we get to the same point anyway. We'll look at tariffs and the legality of them. And then also the big question around Greenland. I think this could be a really, really significant thing going into this year, simply because of the position that it puts so many countries in. And it's a position that a lot of them absolutely do not want to be in. It's not like the Russia-Ukraine situation or even Venezuela, where there's kind of a shared enemy, if you will, or a shared villain, if you want to follow it as a narrative type thing for the West or NATO, as you might put it. Whereas with Greenland, it is countries within NATO. It is essentially Europe versus America. And that's absolutely not where people want to be. And that creates, well, some rather tricky questions. So we'll try and deal with some of those as we go along. The first one's the Iranian civil unrest. Now, we weren't looking for this last year. You know, a lot of these types of things, the new Fed chair story, for example, is a story that we've known is coming for some time. It's a story that we know we're going to have to face at some point, and you're looking at in terms of, well, how soon do we face it and what's the implication of this? The Iranian civil unrest, though, this has kind of suddenly brewed up, and we've seen a couple of instances of this in past years. We had it with the assassination of General Soleimani at the beginning of 2020, an event that kind of often gets forgotten because of the events of 2020. We also had the Israeli bombing of Iran last year, followed by the US bombing of Iran last year and the retaliations. So we've got a decent template for this. And as this escalates, you guys will start to see, some of this templating. In particular, one of the things that I'm looking for is the de-escalation trade. We've seen this twice on Soleimani and on the US bombing of nuclear sites last year, that the retaliation, which ultimately leads to the winding down of that trade, is something that has quite a distinct pattern in it. So where's the potential trade? Well, what you've got to do with any theme is take from where you currently are and ask yourself, well, what's the next step from here? The obvious two next steps, and on the whole, you're generally going to get a more positive result and a more negative result, depending upon how you deem positive and negative. But we could see this settling down. If this settles down though, and I'm talking sort of settles down in a more peaceful way, yeah, the current Iranian leadership agreed to sort of reduce the fighting with the protesters, the sort of putting down the protests as it's happening. We then get a question of same leadership or new leadership. So on the face of it, this is the kind of trade that probably doesn't offer us all that much. But this question then starts to become the theme. So you can always start to be thinking a couple of stages ahead that this is probably not really much of an action. But the questions around here are, and that's going to be quite a significant potential trade. We could see sanctions going on to Iran to try and force out the old leadership. We could see other actions in terms of trying to install new leadership in Iran without the need for action. There's a lot of different permutations. So this would be one that on the face of it might not seem particularly interesting or tradable, but one that then has further permutations. We've then got the opposite, which is US action. Military action, sanctions, either of these probably take you down the same route. The difference being sanctions probably takes you down the route of just trading oil because the sanctions predominantly are going to hit oil markets because of the scale of or the scale of oil production relative to the size of Iran's economy, i.e., oil's a huge element of their economy. From a military perspective, this is where it then starts to break out even more so into things like S&P. We could even start looking into safety plays into bonds. So you got to start thinking, how does this impact the markets that I'm going to trade? So this is one to keep an eye on. Yes, we've had some positive story on this of late. This story has been by far the best day of the year. That was this big sell off. This is your 1 minute chart of it. And that gave us around about 200, 250 ticks over the course of, well, 200 ticks over the course of sub 5 minutes. And then you were looking for that continuation onwards, which came over the next kind of half an hour. This was all down to Trump's comment that have been told killing in Iran is stopping and there are no plans for executions. So from a story that seemed to have zero traction at the beginning of the year, this has been the biggest day of the year and all on really 1 5 minute window. And this is such an important thing to remember as well. A lot of performance comes in very short bursts, very significant moments, very significant moves, but generally reasonably quite short lived. Really important thing to remember that your performance is not about trying to be in the market all the time. It's not about constantly trading. It's about recognizing the significance of some opportunities and really maximizing those. Onwards to the new Fed chair. So, as I say, I've kind of wrapped up the subpoena and the new Fed chair into one. On the whole, the best place to look at this is to go to Polymarket. If you go to Polymarket and ask the new Fed chair, it gives you the probabilities based on betting of who the new Fed chair is going to be. Next step, go and find out what the implications are for each new Fed chair. The two front runners at the moment are Hassett and Warsh. Change the color of my pen again. Hassett and Warsh. If you go and whack these two into any kind of chat GPT AI, it will give you a sense of their likely policy. One of the significant questions with a new Fed chair is credibility. Hassett, being essentially a current member of the government and a favorite of Trump's to go in, one would assume is going to follow the line that Trump wants and lead us straight towards rate cuts. This presents new problems as well, inflation and credibility. So with a situation like this, when you know what the outcomes are going to be, could be Hassett, could be Walsh, it could be other. You first up got to trade on who it is. If you feel that the market has got a perception of either of them and if there is a seeming pricing. At the moment, it seems that the market's not clear pricing wise which one it is, but we've not seen a great deal of movement either. My take on that would be that on the whole, the market doesn't necessarily believe Hassett's coming in. Hassett is deemed broadly as a bit of a loose cannon and probably not a good choice from a credibility perspective. So if Hassett does come in, that needs to be priced in. What needs to be priced in is more rate cuts and probably higher inflation. And that's where the tricky part of this trade comes in your market choice. You've got to ask yourself, what markets move the same way on both a rate cut and inflation and a credibility problem? And that leads you really towards the euro and towards gold. You can do your own research on this simply by looking at when the subpoena came out over last weekend, which markets moved and where did they go on this. But if you look at it from, say, a rate cut perspective, if Hassett cuts rates, that should be a buy for the euro against the dollar. So dollar weakness. If inflation rises in an environment where rates are not going to go up, that is also a reason for dollar weakness. And if credibility diminishes because of Hassett, that's also a reason for dollar weakness. So it makes sense then logically that euro dollar would be the straightforward trade. Akin to that is gold, which also has similar aspects. Rate cuts, gold should rally. Inflation, gold should rally. Credibility, gold is a safety play. Gold should rally. Now, I'm not saying it's an absolute banker these things will happen. And the timing of the execution of that is a completely different trade. But fundamentally, the idea of the trade is there. The other one is Warsh. Now, Warsh is more aligned with the economics side of things. He has, if he's not been at the Fed, he has, got very close ties to the Fed anyway. He would seem like a more credible choice. And I think on the whole, markets would react on the basis that he's not Hassett. I don't mean there's necessarily a wash trade as such, but he's not Hassett. And that's the positive aspect of that trade. Policy, whilst you can assume is less is more dovish than Powell, less dovish than Hassett, it is ultimately an unknown. And so the Warsh trade is perhaps not as clear here and is one that, a bit like the Iran story, this is one that develops. This is one that's got straightforward action on it. And that's one of the other things to try and think about. Well, what of the two scenarios do I really want? Probably on the face of it, you want Hassett, because Hassett provides instant reaction and then also a greater degree of volatility around the balance between rates and inflation and credibility. So try and think through your themes, run them through, run the permutations through, create yourself your own sort of tree diagrams, if you will, and work out what exactly you think is the best approach, what exactly you think could happen here. The reason for doing this, and I've mentioned this to guys on Blueprint, the reason for doing this is by coming up with varieties of different scenarios and different things that could happen. What you're doing is giving yourself a greater degree of creativity. You're opening up the possibilities of things that you perhaps haven't considered. And many of them won't happen. But if you don't consider anything at all, there's a guarantee that that won't happen. But the more things that you've considered, the more able you are in a very short period of time to imagine the impact of some of the others, if you will. So some of the other scenarios or a completely different scenario, you could at least quite quickly get yourself to understanding what that scenario is if you've gone through the process of considering other things. In terms of market selection as well, what is so important when you get any kind of news is go and have a look at what the reactions are. If we look at something like treasuries, which you would think, okay, rate cuts on Hassett, or they're getting rid of Powell, rate cuts. Well, this fades out. This is over the course of Monday. Got that news over the weekend. The 2-year fades out. Gold continues. The euro continues. A little bit of fade off. The S&P drops and then rallies. So what you can take from this, I don't want to be going into any of these future coins going, well, it's absolutely clear what's going to happen. The S&P will drop and then I can buy the dip. Maybe. What I'm looking at this more is to try and make the choice of this is not exactly convincing in direction. Neither is this. So where do I want to be? I want to be looking at something that I can at least be confident in what direction it's going to go and that it's going to sustain direction. Really important thing. Don't get sucked into just the looking at the simplicity of it. If you look at it and say, Hassett, rate cut, you're going to be buying treasuries all day long. And if you buy treasuries literally all day long, well, you're going to end up losing money. Look at what the market's telling you. It's telling you to look here, look to gold, look to euro as the ones that actually sustain the movement on the back of this information. Really, really important thing to do. The reason that I've referenced SR3, and if you don't know what SR3 is, I'm going to leave that to you to go and do a bit of research on it. I'll give you a little sense. It's short-term interest rates. If you want to go for a bit more detail, go and look up precisely what exactly they do. But very simply, the reason that this should move is inflation doesn't affect short-term rates because inflation is something that impacts over the longer term. Short-term rates expire over very short durations, so are only really impacted by changes in interest rates. That's crucial. I'll explain that in a little bit more detail in just a moment. We'll go and look at the implication for rates. Final thing then is the Greenland story. This for me is probably the big risk on, risk off situation. You've got the simple invasion threat. If this happens, then you have the question of does the EU or Denmark just back down and accept it and let America have Greenland? Or do we end up with ultimately, if you take this to the extreme, European-US war is the most extreme scenario in it. So we do have a situation where that tension is building up. And this is perhaps your sort of big event of the year if it does really come to pass that this turns into or follows this line and then potentially onwards from there. That's your big event of the year, I would think. The alternative is we back down. If there is a back down from America, though, we could just go back to no change and that was it. It was a lot of big talk and no action. We could see more tariffs on Europe. Donald Trump does not seem particularly keen on Europe, full stop. And tariffs on Europe, he does seem relatively keen on. So would not be surprised to see more tariffs on Europe. And that is the other part of the trade there, that he could try and tariff Europe out of owning, or tariff Denmark more to the point, but probably Europe as a whole out of. So that's a different approach. So make sure you're thinking your themes through. In terms of the rate side of things, this has been a big part of the last few years, really since COVID, 21, 22, 23, and even 24. Rates were a really big part of it. Last year, we didn't see so much. We saw sporadic moments of rates being significant, particularly as we went through the back end of September. And so really Q4, where we went at one point from expecting one to maybe no cuts for the year. Then we moved to 3 cuts for the year. And so we've had a fair bit of movement in the last quarter. It would seem now relatively clear where we are. If you go back as far as looking at the beginning of 2023, there was very, very little expectation of rate cuts. In fact, we were looking for rate hikes before cuts. So no real expectation of anything. Bear in mind, we had gone as far as here, so nearly 5.5%. Start of 2024, the expectation was some pretty heavy cutting. And where we are now, we are just down here. So we've got there by the end of 2025. So we've not dropped rates as fast as perhaps was expected. You were looking at 2024 to see some pretty drastic cuts coming in. Bear in mind, 2023 rates actually continued to go up through 2023. And then we were looking at 1, 2, 3, 4, 5, 6 through 2024. We did not get that. So we've had slower rate cuts than perhaps expected. This is where we are now. So the 3.5 to 3.75. And the expectation of any further cuts is very, very limited. You're looking at maybe 2 cuts by the end of the year. And that's a very strong maybe. And then nothing for the following year. Now, what this means is that the focus on rates is going to diminish. Arguably, the significance of data may well diminish as well, because we're not in this stage of fluctuation. We're not in this stage of uncertainty about where things are going. It's not that necessarily rates are obviously rising or obviously falling. It's the fact that you're not entirely sure where they're going, which is where the opportunities really lie. This period, for example, we knew rates were going up. There was inflation. There was the highest levels of inflation that we'd seen since the 90s, even since the 70s. So rates are going up. What you didn't know was how far. That was the bit. That was the uncertainty in it. How far, how fast are they going to go up? We went 25, we went 50, 75, 75, 75, 75, 50, 25, 25, 25, 25. There's a lot of pace in this and a lot of uncertainty about when the top is, how high that top's going to be. We've had similar questions on the way down as well. But with that level of clarity, unless anything shakes this up, the focus then starts to move to other areas. We start to see more and more looking at perhaps sentiment data, growth data. We start to look more at broader performance of the economy than necessarily the data points that impact interest rates. I think it's worth recognizing where we are and recognizing where the expectations of direction are. If, however, we continue to follow this direction, then I think that probably leans us towards assuming a more limited rate environment to be focusing on. So for those of you who don't particularly like central banks, good times for you. We have performance. This is something I really wanted to try and then have a little look at. What's really important to think about here is the level of performance and the relationship to environment. Because ultimately, the big performances from last year were all focused predominantly on the first half of the year. If you look at the first half of the year, that gets us to here. There's some huge day-to-day performances in this. So you got this huge run-up to here. We don't see a great deal beyond that for the rest of the year. Don't get me wrong, it's still not a bad performance, but we don't get loads and loads more. What's really important about this is recognizing the environment that you're in and recognizing the level of opportunity that you're being presented with and the types of opportunity. If you did particularly well in Q1 of last year, well, ask yourself why. What was it that drove that performance? And try and characterize the previous years, because that way, if we move into another period of sort of consistent tariff narrative like we saw in Q1, you have a good sense of what to do with it. We had this sort of volatility explosion in Q2, which was related to tariffs. That was the post-Liberation Day. And this is where the biggest performances come from. You've got a market that's highly sensitive, highly volatile, put it in very big ranges, and then this constant input of new information relating to tariffs. That's where the big opportunities really lie. Q3 was broadly technical. We lacked a lot of clear opportunity throughout the entirety of Q3. It was a very limited period. And then Q4 really suits those who are able to react to constantly changing bits of information, those who can keep multiple narratives alive in their head at once and be able to respond to any one of them that come up. We had all sorts of things, tech crises, we had periods of geopolitical uncertainty, we had Fed actions. There were lots and lots of different moments without there being a general theme. It's really important to understand what environment that you're in and what broadly is going on, because that way you're best equipped to actually perform in those environments. If you know that you're really strong in technical environments, whilst broadly that was the lower performance period of the year, you can still perform really, really well. For some traders, their year was done by here. For others, they're only halfway in terms of performance. It depends on the type of trader that you are. For some traders, they will have sort of, followed an equity curve that moves more like that. Others will have outperformed even what looked very good at the beginning of the year anyway. So it's about recognizing where you're good, what it is that you're particularly strong at is so, so important. You're never going to get, if you're looking for lovely straight line performance, you're never going to achieve that. If you get lovely straight line performance, what that basically suggests is that you are massively underperforming here and overperforming in a period that probably doesn't offer many opportunities.